All right, Michael, let's jump in. I'm excited that you're here. I'm just going to give a quick intro to the community. I've been telling them all about you, so they probably are going to know some of this. But I'd like to welcome my guest, Michael Zuber, author of One Rental at a Time. He's been investing in real estate since 2001. Gosh, it's hard to think that two guys like
Yeah.
us have been doing anything since 2001, but I can say the same thing. He's built a portfolio of over 170 units with his wife. Today, he mentors new and part-time investors through his popular one rental at a time community. And he's got a YouTube channel, which is how I found him, with more than 70,000 subscribers, where he shares practical strategies for building wealth, one property at a time. He also has regular discussions with other experts about where they think the economy is going, where the market's going, which is what we want to discuss today. So thanks for taking the time, Michael.
Absolutely, Jeremy. I think this is it's important to have these discussions, ask real questions, get to the meat of the situation. So happy to go anywhere you'd like.
Great. So I'm going to drop a couple links a few times. I want to make sure people know about your school community and your channel. So I'll post that a few times. Um,
Appreciate it.
Everybody's jumping on, which is great. So the reason I reached out is for what seems like 2.5 years now, we've been predicting interest rates up and down with almost no activity, right? But interest rates did actually go lower. Something actually happened. And interest rate mortgage interest rates went lower in anticipation of this cut, which they typically do. The market kind of, susses out what they think is going to happen. And I saw some research or some data last week that we had a huge uptick in refinances last week, something that was amazing, all probably relative to a low bar because almost nothing happened last year. But we won't know if these changes have any effect on the actual real estate and housing market.
Mhm.
So just, opening shots, what do you make of this cut? And is this any of concern of the investors that you're working with?
So there's lots of things there. So we'll try to go through the layers and give everybody kind of the big, the full cake instead of just the frosting. Hey, the Fed cut rates.
Yeah.
So you're absolutely right. Mortgage rates, and when you think mortgage rates, I want you to think long end. And when we say the Fed rate, I want you to think ultimately the short end. And if you've been paying attention, the last time the Fed cut interest rates last year, 100 basis points. So that's like going from 6 to 5, for example, right? A full point. Mortgage rates actually went up 80 to 100 points. And that's not normal. So we really had to ask ourselves, why was that? And the reality is people thought that these rate cuts would spur inflation. And that's why mortgage rates actually went up last time, which really blew everybody's mind at the time. So we were going into this Wednesday where mortgage rates had already started coming in. And mortgage rates really came in for two reasons. One, you're absolutely right. There was anticipation from the market that the Fed would cut. So you're absolutely right. But there was actually a second and equally important, and that is the spread. For layman's terms, you could take the 10-year note. So I think the 10-year note on Friday was 4.1, rounding to 4.1. And if you use the historical spread of 180, which would be 4.1 plus 1.8, that means mortgage rates historically should be 5.9%. They're not that today. They're 6.2% at the end of Friday. So what does that mean? That means there's still some spread above that. And if you go back in time, we actually got over 300 basis points during the pandemic. The spread was ultra wide.
Yeah.
So the big question is, A, do you think the spread continues to get back to normal? I do. Why? Because again, you have to realize there's not a lot going on in mortgage. And if there's not a lot going on in mortgage and you're paid to create mortgages, you're going to have to collapse that spread to gin up business. So we did see the spread come in quite a bit in the last 30 days. And I think that continues over the next 3 or 4 months. Then what happened on Wednesday? I think there were two things. One, the Fed's a mess. The Fed is just a mess. If you look at the dot plot, there's actually one Fed president that thinks we're going to raise rates. Then there's one Fed president that thinks we're going to cut 5 more times this year. So that's a spread of 150 basis points. We have 6 Fed presidents saying zero. We've got 9 saying two. So I've been watching the Fed for more than 30 years. This Fed is a complete mess. They don't know what they're doing. There's no North Star. So we're really going to have to pay attention. Second, the Fed is clearly, I think, articulated, and this starts at Jackson Hole when Powell was in front of everyone, basically saying jobs over inflation, which was a pivot. Before that meeting, it was believed that Jerome Powell believed inflation over jobs. I think he has flipped that. And lastly, we've started a rate cutting cycle. So I did have a fear that Jerome Powell would come out and be very hawkish and basically say, "Hey, here's your token cut. We're done. Don't ask for more." But given the dot plot, it does seem like most Fed presidents think we've started a series. So you can expect October and you can expect December with maybe one or two next year. So we're definitely on a rate cutting cycle. And I think banks and mortgage providers are hungry for business, so they're collapsing the spread. Net, I think rates gradually go lower. I don't think it'll be any dramatic move, but they'll gradually go lower.
Yeah, it's all analysis, and it's also great to point out that residential lending is also a business. So there's also, like you said, the supply and demand. So obviously, people need to make money on the money they borrow, and the
Yep.
Fed is a that filters into what money costs people. But you're absolutely right. If we went 6 years without any mortgages, I mean, we'd lose an entire industry. So it's
Oh,
not
of course.
always a one-to-one correlation with the Fed rate cuts. It's a really important
No,
thing to point out.
no, I think we're going to see more mortgage lenders get aggressive. Um, they have to even keep a heartbeat.
Yeah.
So watch for the spread to narrow.
Yeah, I can't imagine going from the hot, Lollapalooza spigot of refinancing and mortgages that we had post-COVID to just the absolute,
Yeah.
graveyard, nothing, no activity for real estate agents too, but even more
Mhm.
for our friends in brokerage. It's got to be
Yep.
absolutely. All
Yeah,
right, so
absolutely.
you're talking to investors all the time. You're actively
Hmm.
investing.
Hmm.
What do you make of this right now? What are you guys doing? Are you all just sitting on your hands? Or are you saying, "Hey, this is great"? Or are you saying, "Hey, we knew this
No,
coming and we
yeah.
were jumping on this before"?
So I think well, if we stay on the mortgage angle first, I think there's three things going on in mortgage, and you pointed out one of the three already, and that is rate and term refis. Last week we saw refinances that they don't break them down rate and term, but I talked to five different mortgage brokers every week, and the lion's share of their business spike was rate and term refis. Why did that happen? Well, if you rewind the clock 2 years ago, there were a lot of these YouTube gurus and real estate agents, frankly, pushing buyers to do what was called 2-1 buy downs,
Mhm.
right? So you basically got a 8% mortgage rate, but for the first year it's 6, and then year number 2 it's 7, and then year number 3 it's at 8. And that's called a 2-1 buy down. And what we heard from a lot of buyers is they really stretched to get into that. And the 2-1 buy down is the only way they could make it work. So the first thing we saw is a lot of people get lucky. They just got lucky. We had rates come down significantly. At one point they were 6.13, and there was a lot of people jumping in because they were about to be in a lot of trouble. Right? A lot of these 2-1 buy downs were coming up or already due, and they were now paying the 8% mortgages because that's where we were 2 years ago.
The free money
And
was
it wasn't
running
a full.
out. Yeah.
Yeah, the free money was running out. So basically, they're breathing a sigh of relief, and you saw 70% increase in refinances last week, and likely to see an equally big number on Wednesday when it's posted again. So step one of this is anybody who had rate and term or a 2-1 buy down, their rate and term refis spike. But that's a moment. That's like, you know, 6, 8 weeks. That's not going to save the mortgage industry. What I believe is step two, and only comes if we keep mortgage rates floating like a feather down, right? We stop this. The last time we were here, we went right back to 7%. But if we stay here at 6.2 and we just keep gliding lower and we finally get below 6, I think step two is more interesting. And this is for the investors. These are the people like me. Like this is me. I have a portfolio that has more equity in it than it has ever had, right? If you've owned real estate for the last 5 years, you're up 50 to 80%, right? It's just, you got lucky. However, as somebody who has this equity and knows how to deploy it, I am not opposed to doing cash out refinances in raising six figures or multiple six figures and to go shopping. So I think what's in the very near future, we're talking middle October, November, if rates glide down, is we're going to see another refi boom. But this won't be rate and term emergency. This will be investors going, it's time to eat. It's time to get some dry powder. It's time to go shopping, because the best time an investor wants to shop is when nobody's looking. I have done, I think I looked one time, 60% of my deals are between Halloween and New Year's Day. Ask yourself why. That's because when the retail buyer goes to sleep. So if I get the opportunity to extract multiple six figures, sub 6%, I'm going to go aggressive and write just stupid, disrespectful offers because all the retail buyers are asleep. So again, that's what I think step two of this is. And if we're going to go to step three, that's when the purchases start again. More specifically, what I call the move up buyer. The reason the housing market and mortgage is so dead is the largest part of the market, the move up buyer, the sell one, the buy one. That's two transactions. That market's dead, right? They're locked in, right? They've got 2% mortgage rates and it's stupid to move. But if we get mortgage rates, it probably has to go sub 5, maybe even sub 4.5. But if that ever unlocks, party time. So again, I don't think we get back to 4.5, but hey, stranger things have happened. But that's what I think unlocks the move up buyer.
So I really appreciate that and how you're breaking that down. What the takeaway, I'm going to make sure I'm getting this right because this is the first time I've heard you say that and really thought about it because I can't watch your 12 videos every week, Michael, although
I understand.
like
I
him. Oh,
understand.
if you're watching, he goes live like 3 times a day. It's amazing. Um, so there is right now we're here, whatever that number is, and
Call it, yeah.
where the retail, sorry, yeah, where the move up buyer, Jill and John Doe who want to move into
Mhm.
a home, there's a spread where they'll actually start taking it seriously.
Yes.
And the opportunity for the investor is in where it does come down and it starts making it more monetarily available, but
Mhm.
the supply and like the market forces won't move in. It won't move in the millions of Americans who are waiting with their 3% mortgage rate to finally move,
Yep.
or somebody who just hasn't bought yet, who's been saving up
Yeah.
money. And so the investors can't wait for it to be so low because
Oh, no.
the
No.
market will drive up the prices so crazy, right?
No.
So am I
Yeah.
understanding that right?
No, absolutely. Again, I can only scream from the hills, but in real estate investors should start getting excited now. Why? More inventory, less buyers, higher chance of finding a motivated seller. If you are a good or great real estate investor, if you are elite, your job is to create good deals or great deals. We don't pay list price. We get seller credits. We make sellers repair stuff. We are asking for the moon in this environment. We are in or very close to being in a buyer's market. These do not last long. I promise you this will not last a year. So get aggressive, write what I call disrespectful offers, make the numbers work today. And then if you get lucky and they go lower, refinance later. But don't bet on that. Don't bet on appreciation. Don't bet on the market helping you out. Write deals that make sense today at 30-year money. Just write them below list price. I have written offers 15, 18, 21, 27% below asking. Now, don't be stupid. Don't do this on first day listings. Don't do this on the first 7 days. But, at day 37 or day 97, send out a disrespectful offer. See what happens.
That's a great point. I mean, when you think about how a market works, supply and demand, yeah, 100 days on the market, there's just different realities. Maybe that property is overpriced, or just maybe there is not a
I
lot.
would argue it is overpriced,
Yeah.
right? If it's been on the market 100 days, it's overpriced. Now, here's the problem. The seller may not have to sell. So again, the seller may say no. The seller may be one of them that says, I get my number or I don't care. That's a legit seller. But in today's market, that's just going to be an expired listing. That's what I call wish pricing.
Yeah.
It's just not going to sell.
Agreed. Yeah, especially yeah, where that property is located, the people looking in that market. There's a lot of factors here. And the
Yep.
people looking to buy a property in a market does not equal the people looking to rent a property in that market, right? And so
Right.
that's where the investor can really get smart, find that
Yep.
arbitrage.
Yep.
Okay, so I was going to ask you about what a more significant drop would do, but I think you answered that. Basically, you're saying, and by the way, you told us that the Fed was confused, and I remember that dot plot. I looked at that. So for if you're playing along at home and you haven't followed this stuff, there's a group of people. It's like a Congress getting together, deciding and recommending or thinking what should happen next, and they give that to us, the public, to do what we will with that. Right? They're never
Hmm.
quite giving us the answers. But what we're seeing is that they're not marching in concert at all. And so
No.
anything could happen. But any predictions? I mean, end of the year, I mean, do you think it'll just be right here for a few more months, or do you think it's going to trickle down or float down like a,
I think it's the feather. I mean, again, I do not think any extreme moves. I think it could get below 6 by the end of the year. 599 is below 6, right? 595. I don't think it goes much below that. I said the move up buyer unlocks at 4.5. I don't see mortgage rates getting there, right? In my opinion, it would take a pretty significant recession and the Federal Reserve to start buying back mortgage-backed securities, which I don't think they want to do because that's what caused the inflation last time. So I don't see 4.5, but I certainly see below 6.
okay. All right, so I'm gonna ask a quick question about different markets, and then I want to
Sure.
pivot to talk about what I think a lot of people on this call are curious about, which are the people that didn't think they'd be getting into being a landlord, the accidental landlords, which you're talking about. So I want to
Yep.
save some time for that. But
Mhm.
given that you've got access to so many people, I always when I can talk to someone who's seeing the whole country in a swath, like you and I talk to Lance all the time.
Mhm.
Um, but it's different because Lance just reporting on the facts. You kind of know the sentiment and you know the
Yeah.
activity. So where are investors excited about? Where are they not? Is there anything about regions of the country or types of property? Anything you can share with us about some inside trading info that you're seeing people get excited about?
Yeah, I would tell you right now the most energy I see in real estate investing is what is called co-living, right? Pad split, and I'm sure there are others, but it's the only one I'm aware of.
Yeah.
I think there's a lot of people that see affordable housing as an issue. It's not, just be clear, it's not something I do. I own zero of these.
Mhm.
But it is something I see a lot of energy around. In fact, it reminds me a little bit of Airbnb and VRBO 4 years ago. So much excitement, it actually makes me nervous
Yep.
because you can see cities and counties and states, turn the angle on them and outlaw them. But again, I see a lot of energy there. I see a lot of people, taking 4 and 5 bedroom houses and making them 8 bedroom houses, right? So I see that. I see that a lot. So I think that's something. I do see a general, it's very tough in the Northeast. I think the Northeast is still very much, or at least acting very much like a seller's market, right? It's one of those markets that's still up and to the right, where the Sun Belt is very much a buyer's market. Arizona, Texas, all the way out to Florida. That's probably the weakest market. Um, I think, I still think there's a lot of pain coming in the multifamily space. We're talking 50 units and above.
Yep.
They had too much syndication and too much value add and too much bridge debt. I think banks are really starting to scrutinize and foreclose. So I think there's a lot of pain coming there. So, again, as a real estate investor, I think there's plenty of opportunity. You just got to do the work, do your research, and, write great offers.
So some takeaways that I want to share there, Michael, just knowing my audience. So just imagine I'm
Yep.
only working with like single family and small multi-residential managers.
Sure.
What I'm
Hmm.
taking away is one, it's a great opportunity if you are courting a list of investors looking to invest in your market, that if there's pain in multifamily, some of these guys would kind of turn their nose up to single family and get excited
For
about
sure.
multi over the last 5 years. So there's a
Hmm.
chance that those people will take your phone call or talk to you a little bit more because they're excited about the asset class.
Yeah,
Um,
if I was market, let me just tell you, if I would think that's a great point. If I was marketing to that group, I would highlight, and there are examples. You could go online and just take some examples of properties that have been foreclosed, right? I remember one building in San Francisco, 87% drop in value. right? I would highlight these things because these are real. There are people losing hundreds of thousands of dollars. And
No.
then I would pivot with what about a fourplex, right? 30-year fixed rate debt, don't need partners. I think that's a great message. Right? Don't get lost in the, sizzle of, 100 units and you own 1%. Just own 100% of a fourplex. Yeah.
Yeah, that's the thing going back to supply and demand. I've been saying this for a while. There are some people that literally outgrow these multi-properties. And given how underbuilt we are, I mean, there's just some people need four walls in a backyard. They might have three
Yep.
dogs,
Oh,
might be
amen.
having their fourth kid. They might just be over that they moved into a multifamily property when they were 22 and they've been living in it for 20 years and they're ready for something else.
Yes.
And while multi has come online at a dramatic rate, single family has not. And I know it's starting to slowly catch
Correct.
up. Yeah, four walls in a backyard is just a different asset class. And I don't mean an asset class for an investor. I mean something that people want to live in. And so there's always going to be that supply and demand, which is great. The other thing you shared is I will share with you. It would be sacrilegious about 3 years ago for any of my clients to ever consider co-housing unless they were in a student housing environment. So
Sure.
I'm overgeneralizing, but to share some intel back with you, our clients would have never considered that. And slowly but surely, our coaches are hearing that they're getting more into, hey, the only way to make numbers work in this property is to do the pad split or something like that.
Yep.
And I think it's interesting because I always say like everyone thinks Warren Buffett underpaid for everything, but when you read Snowball, he would
Mhm.
overpay compared to everybody else. He just saw how to get more value out of it. So an
Correct.
investor coming in and looking at a 4 bedroom with a ton of space and learning how to turn it into a 6 or an 8 bedroom, they could seemingly be overpaying for that property, but not really because they'd be
Mhm.
using it very
No,
differently.
absolutely. I mean, yeah, if Warren Buffett didn't want a bad company at a cheap price. He wanted a good company at a fair price. And that's a very different mindset. So, yeah, again, co-living, I really do believe co-living will be the answer for a lot of affordable housing. So again, it's definitely worth the investigation. It's worth getting right. But you got to remember, you're now going to have 8 human beings, living in a house, and that's a different animal than a long-term lease. But I'm not saying it's bad. I'm just saying it's different.
True. And for the audience on this call, property managers get paid to solve the problems that other
Yep.
people don't want to solve, right? And
Amen.
so that's a good point,
Amen.
right? I mean, I know I've heard you say you work with you don't self-manage anything, right? You're all
Not a chance in hell. No chance.
exactly. So yeah, sometimes the stuff that seems icky and scary is the stuff that you get paid to solve. And
Amen.
I was excited just this morning when I was working out. I saw some of your friends talking. I saw Pace Morby was on
Hmm.
Stefan's
Oh yeah.
coffee hour, and I listened
Yeah.
to it. And he was I don't know if you saw it yet, but he was
I
saying
did.
I think
Yeah, I did. I was actually at an event with Pace this past Sunday, and he's big into this. It's like his answer to what's coming.
yeah,
He
yeah,
believes in it
usually ahead of
wholeheartedly.
this curve.
He
But
is.
he made a great point that he said, well, why is co-living there? It's just because housing keeps going up, especially rental housing, and
Hmm.
income has not kept up with that. And I think I don't know if you know Jason Hartman or follow him, but
Yeah,
I'm
yeah,
him.
yeah. He and
And
I talk every Monday.
great. So I love Jason. I think he's been saying for a long time, if you go to South America or go to Europe, it's just more common for multiple generations of a family to live in the same house.
Oh,
But
absolutely.
we in the United States have just gotten used to like having acres of property and just this every person, the American dream is to have your own house.
Yep.
But when population out drives the supply of that housing, what is the term he always says? People just adjust their expectations, right? And so
Correct.
I think
Yep.
it's a great point. So I think we're really early in that trend. I think a lot of people are not thinking that way, but
Correct.
pace
It's
is
coming.
seeing around corners.
Yeah, he does. He
Yeah.
is. He's very good.
So I really appreciate you bringing that up. And like I said, just some intel for you. Some of my managers would have thought that was sacrilegious just a couple of years ago, and some more and more are doing it. We're
It's
adjusting.
coming.
Okay, so let's just talk about general economy. I'm gonna let you go anywhere you want with this because
Mhm.
you talk about this all the time. But I want to tee this up with saying so many of our clients have been inundated for obvious reasons, the lock-in effect, the basically stalemate housing market.
Mhm.
So
Mhm.
many people have become accidental landlords over the last couple of years. And
Yep.
I've been saying, I think this is fantastic because if I read one rental at a time, and I go to your seminars, I'm going to learn that it's going to be really hard, and I have to like save just to buy my first rental property. And I think
Yep.
there's a wave of Americans who got defaulted into the one rental at a time plan without even realizing it. Some
Hmm.
of them might survive, some meaning they'll build the appetite for it. Some
Right.
people are truly just holding their property in a time machine and they can't wait to get out. I'm just curious, whether you want to think about it's the economy, it's the rates, because I do think the rates have like a big part of this. But accidental landlords, is that a growing trend? Is that a shrinking trend, or is it just a new asset class that Americans have?
Well, I think we've always, I think becoming an accidental landlord was always available, but I think we went through a very unique cycle, moment in time, where a large percentage of folks bought or refied with mortgage rates below 4%, many of them below 3%. And if you believe the government stats today that inflation is 3%, you've eventually borrowed money for free for 30 years. And, you know, if you can ever borrow money for free for 30 years, you should do that. You should borrow a lot of money. That's just how the system works. So I think there's a lot of people that are looking at their personal financial statement and going, damn, we got this house, in 2021. Our payment is our payment's artificially low. It's $800 because we got a 2.3% mortgage rate.
Yep.
And this place will rent for 2 grand. And I think more and more people are going to look at this going, well, I guess we got to become landlords, right? It wasn't the plan, it wasn't the intention, but it just makes a financial sense for a lot of people. I think, and I've said this many times, if you have a 30-year money below 3%, that is a very good chance that that will be your best asset ever.
Mhm.
Borrowing 30-year money at sub 3 is an amazing asset, and you should do what you can to keep that. So I think many people will say, "Oh, guess this has becoming a rental." But if you really step back from this and you tie this together with one rental at a time, what I tell people to do is go buy a new house. All you need is 3.5, maybe 5% down. Live there for a couple of years, maybe 3 years, and then do it again. And then just keep it as a rental, right?
Yep.
And then after a decade, you own 4 homes where tenants are paying you for it. And again, inflation's a feature, not a bug. So if you've owned one asset for 10 years and a second asset for 7 years and a third asset for 5 years, this is starting to compound like Warren Buffett's snowball, right? Back to your snowball comment.
Yeah.
So this little snowball, when it's at one house, becomes a little bigger at two and a little bigger at three and a little bigger at four. For some people, they get to four, they're going to have an amazing retirement. And I think more people should really think about getting to 4 rental properties because it's life changing.
I agree. And I think for the listeners out there who have woken up with a significant growth in your portfolio of accidental landlords, now is the time to be sharing this message now. Before, listen, we know people are highly, herd mentality. There's going to come a point where the rates drop or maybe the rates don't drop and the market appreciates like we know it's going to. And they're sitting
Sure.
down with their friends on a Friday and they're like, hey, we just sold our property for $40,000 more than we thought it was worth, just like they were in 2022. And when they start
Yeah.
hearing that, they're going to start reacting to that because they are. So I do think, we have not only a responsibility, but an opportunity to start that education now so that they can make the best decision for them and not just a knee-jerk reaction because we know that's going to happen. And then you've got people like Michael waiting to buy those properties.
Yeah, exactly. Yeah. So at the end of the day, the consumer, I have an econ degree, MBA. I've been studying the consumer in detail for 30 years. The consumer is very hard to predict day to day, but if you step back and you look at quarter by quarter, they're really predictable. And this is what's coming. Right. Here's just an example that you can note down and will likely happen in the next 6 to 9 months. It is true to say that we have record credit card debt. Just is. Go Google it. It is also true to say we have record home equity. Also true.
Mhm.
If, like I said earlier, rates go sub 6, some people like me are going to take cash out to go shopping for assets. Other people are going to go to the ATM machine called their house, take out cash, pay off their credit cards, and then run the credit cards up again. That's coming.
It's a fairly good observation of human psychology as long as I've been alive. Uh,
Yes, pretty predictable.
it's great. And so I do think I just want to say that as a zoom out. I think that one of the things that makes you very successful, and one of the things that I try to do is the longer term outlook you can look at, like, so Michael just talked about going from day to day to quarter by quarter. I mean, we had Lance on in here, and Lance agreed. And it's like, I can tell you, I'm focused on what's happening by quarter, but we
Right.
all kind of agree 10 years from now, prices will be higher. Like, the longer horizon you look at, the better betters we are. So if
Right.
we're making plans, like you say, I know you use the term season, which is 10 years of your life, you pretty
Yep.
much can't lose. Even when you look at the
Right.
worst economic period of our lives, going after the great financial depression, it was, or whatever, the crisis, great financial.
GFC. Yeah. Yeah. Yep.
I try not to use that term because I'm realizing so few people still know what that term means that are not in our space. But yeah, I mean, it was a
Good point.
crazy time, and prices did not go up for 5 years, but still on a
Yep.
10-year horizon, everybody won, which is
Yep.
validating. So I want to encourage anybody watching that's got questions for Michael to jump in. I think the goal out of this is, what are you taking away from this? What are you going to share with your clients? What are you guys going to talk about as a team internally? Are you going to be writing about this in your newsletter? Are you going to be creating a social post? We'll be helping you guys do that. So just go ahead and drop your questions, either the chat or the Q&A. But I know people are a little shy sometimes when I tell them to start
Mhm.
asking questions. So I'd like to kind of turn it over to you, Michael.
Mhm.
Every time I pull up a YouTube video, which I'm often listening to on a walk or when I'm working
Mhm.
out. You're always just talking about what you see, what you're looking at right now, what you think is important. You're great at the fundamentals, but you've always got your eye on something. So what are you looking at? Like, what matters to you right now?
I think right now we've got to really watch the job market. Something that is not obvious to a lot of people is the job market often falls apart and it looks like an elevator. If you look at the unemployment rate on the chart, it often just bounces around in a little range and then whack, it goes parabolic.
Yeah.
I am concerned we are on the cusp of seeing one of those parabolic moves. And, if that happens, I'm not saying it will, I'm just saying it's something I'm concerned that if it happens, you need to step back and go, okay, what happens next? That's how you make money. Saying the job market is falling apart, whining about the job market falling apart, that's not helpful. But if it does, you need to go, okay, what happens? Well, first thing happens is more people are unemployed. Duh. But what does that mean? That means they're more financially stretched. That means you're going to have more forced sellers. You're going to have foreclosures. You're going to have, if it's bad enough, you will have the banks do forbearance periods again. Everybody remember 6 months of free, no mortgage payments, right? That'll come back. So, but there will be stress in the system. The next thing you need to look at is, what does the government and the Fed do?
Mhm.
They will bring rates right back to zero. And you can expect the federal government, Trump, who wants to stay in power, who must win the midterm elections, they will stimulate. They will create first time homebuyer programs like President Obama. They will do whatever they can to make this recession not last long. So again,
Politically,
never react to the headline, play the game forward.
I love what you just said. It's so important for us to remember that politicians have to be reelected, so they don't always do what's economically correct. They do what's
Yeah, they're not thinking long term. They're thinking election by election.
election by election. That's great. I love that. And I do like that. I really want to just, oscillate on that for a second. It's
Mm-hmm.
really important to think through the difference between complaining or talking about what's happening now versus really thinking about what happens next, right? And
Yeah,
an
it's like
investor,
chess.
yeah.
Yeah, it's just like chess. So the economy made a move. Unemployment rate spiked. Great. What's your move? What's next? That's how you dominate. That's how you win. That's how you make money.
Well, on that note, one of the questions we got in Q&A is if you were to invest in one market today, where would you be going if you're comfortable with divulging that? I know you kind of have your buy box thing,
Yeah,
but
yeah. I'm a very much a buy box. I personally don't. Again, you got to know thyself, as Pace Morby always says, know thyself. I'm not one to be an out-of-state investor, which is really funny because my market's 3 hours away, but I could drive there. So that's always how I get around that in my mental kung fu. But I like to be able to go see my stuff. And so that for me, out of state's a no-brainer, or not a non-starter, I should say, a non-starter. But I do understand, um, so for me, I think if I were to start over today, I would probably pick where I'm spend most of my time in Las Vegas slash Henderson, Nevada. I don't think that's a place a lot of people should go because it's pretty expensive. But again, I believe in doing the work and writing the good offers
Yeah.
and making deals happen, seller financing and the like.
So you're
Uh,
bullish
you
on
know,
Vegas right now. I'm hearing other things on YouTube,
yep,
but you're bullish in
yeah,
Vegas?
yeah, Vegas and Henderson, yeah.
Oh, yeah.
Is if I were to start again, that's just where I'm living. I
Good on
may still do deals in Central California. That's because that's where my team is now,
you.
or is because I've been there 20 years. But if I was starting from scratch, I would definitely pick Vegas or Henderson. That's where I live.
I think
So
that the
yeah.
lesson there is great. Just hearing what I hear in our community is, Michael, I'll tell you, my clients who are mostly investors,
Hmm.
they won't touch California. And
Yeah,
so what I love about that is
love that.
you're saying, I'll make money anywhere. I just need to know the
I
area. I just need
I
to
know
know,
the area.
not the
Yep.
area, it's your local knowledge and belief in the
Yep.
area that you really care about.
No, there's again, it's really funny. I get that a lot. Like, how could you invest in California for 30 years? Well, I'm like, well, first off, the fact that we don't build anything and the fact that it costs 50 grand to get a maybe approval really makes the fact that if you already own something really valuable,
Mhm.
right? So the fact that it's ridiculously hard to build in California is actually helpful if
Yeah.
you already own something. And I happen to own a lot of something. So yeah, it's funny.
That's a great point. That's a moat blocking it out. All right, I appreciate that. And by the way, I mean, if you follow Michael, I mean, one of the tenets he's always going to promote is you don't want to outsource the thinking. He's doing his own.
Yes, correct.
You really talk
Absolutely.
about this all the time. So he's never
Mhm.
going to tell you everybody should go invest in Western Virginia right now because he
Nope.
doesn't think anyone should outsource that thinking, which I think is great.
Correct.
Um,
Correct.
Okay,
Well said.
so got a lot of people on here building their property management company. And
Mhm.
so shout out to Jay. He is in charge of attracting more investors, growing a bigger portfolio. So you've got a unique vantage point. 100 over 100 real estate properties, you're talking to investors all the time. What are you guys looking for when you hire a property manager? And what should we be focused on to be absolutely invaluable to an investor like you?
Yeah, so I think a lot of property managers get this wrong. I think a lot of property managers think investors, and some of us do, but the majority of us don't think it's all about price. I have never seen a good property managing company win on price. It's just not a. It's like you're living too close to the bone. You've got to have other sources of income. One of the things in my story, if you don't know it, is I fired the first 5 property managers I had because they either lie, stole, cheated, or just got unfocused because they were making so much money somewhere else. So I think what you got to tell new investors is you understand what's important to me. Um, Rent quality tenants. It all starts with tenants, quality tenants. Anybody could put any warm body in. How do you do your best to protect and get me the best tenants available? And sometimes that means saying no, right? No, leave it empty. Sometimes. So first, tell me how you're going to get me the best tenants. Second, tell me how you're going to keep the best tenants. Because again, turnover is what kills me, right? Again, you make $200 a month for a year and then you have a turnover, you lost. So get me good tenants, keep good tenants, and then C, tell me how you're going to communicate with me. Because again, as somebody who worked a full-time job, somebody who could be all over the world, I needed to count on my communication. So for me, that was a weekly report, which now for me is daily because it's automated. I get a daily report across my portfolio, I scan and I can ask questions. But in the beginning, when before that was a thing, I had a Friday phone call at 9:15. Every Friday, 9:15, 9:15, 9:50. It lasted 15 minutes. And I didn't have a lot of units. I had 2 or 3 at the time.
Hmm.
But it was that constant check-in, ask questions, and we didn't make every call. Sometimes I was busy, I was on a plane, but I could count on it. They were available. right? So that's what I think, right? The top three is how are you going to get me good tenants? How are you going to keep good tenants? And how are you going to over communicate to me in a consistent way? If you sell those things, your rate shouldn't matter.
I think it's great, Michael. And so some of our clients, it's all ideal client, right? Some of our clients are working with, some actual landlords, and there's no way they're going to make a weekly call with them because that would turn the clients off. But meanwhile, we've got
Yeah.
clients.
Whatever's important to them. Yep.
Exactly. That's what I was about to say. So if you're listening to Michael and saying, "Whoa, I'd love to be working with an investor at this level," this is what he wants. And so this is why there is no one answer to anything in life or business, right? It's what's the outcome you want to create. If you want a client like Michael, that's what you got to do. And that's what's going to work
Yeah.
for you, which is amazing. And like he said, now it's automated. He's got a daily report and he just asks the question he wants when he does it.
Yeah.
So
Exactly.
thank you for
Yeah,
sending.
but the key to point three is ask, so again, what I'm trying to get into is this, like you're trying to court a new client, a new customer. So tell me how you're going to get me a great tenant. Tell me how you're going to keep great tenants. And then how are you going to over communicate to me? Because as somebody who's fired property managers, most of the problem was around something around communication. So you can give recommendations, you could say this is standard service, but then ask them, how do you want to do it? Some people text messages, some people phone calls, some people a weekly email, some people not at all. Give me online access to my data and I'll look there. Just understand that communication, because our fear with property management is you're going to lie, cheat, and steal. So tell me how you're going to over communicate and not lie, cheat, or steal.
Well said. And shout out to anybody who's been through our onboarding training. We always say, ask the prospect the day they sign up, how do you want to be communicated with? Because some people are going to be really annoyed to get 15 emails a week, and other people are going to say, how come you only sent me 15 emails this week? So
Exactly.
ask them what they want. This is great. So I'm getting some great questions coming in. You good on time? I want to respect your
Yeah,
time.
fine. Yeah, good. Yep.
All right. So I have a quick question for you before I go back to this, because you just brought it up about over communicating. Do your property managers ever bring you pocket listings or other deals? Because what we're seeing is, people want to sell their property and they
Yeah.
realize they can't go back to retail. I mean, they bringing you offers?
Yeah, absolutely. I would say over the course of my 20 years of buying, probably 10 transactions were brought, probably 20 were brought to me and 10 were consummated.
That's a
Yeah.
pretty good
Property
close rate.
managers, you have access to deals. I mean, you're going to have people that kind of want to sell, they want to sell, they want to do this, want to do that. Yeah, I would tell investors, property management is, yeah, that should be one of your lead sources for sure.
Great. So 20 deals brought to you, 10 close. I just think everybody's sleeping on this. And I just think there's more value there too, because even the investors don't realize what it takes to sell a property that's got a 10
Yeah.
or 6 month lease on it that hasn't been
Yep.
looked at in 6 years.
Not a lot of people want to buy that stuff. Yeah. But
Yeah.
I will
Okay, that's great.
for the right price. Yeah.
Yeah. So guys, solicit your owners, ask if they're thinking about selling, find
Yeah.
deals, bring it to your clients. Like it's only going to build trust. All they can do is say no. That's all I've always said. Nothing bad happens from offering your current clients a deal. All right. So great question here. Is there any one data point or anything that would make you just slow down your buying immediately? Or is there anything that could happen that would cause you to turn bearish on buying more properties?
No, the beauty of my situation is I only want to buy great deals. So I'll tell you how that breaks down. So again, I get a buy box. I'm very disciplined. I look at it and and for example, let's say my average yield or cash on cash return is 4%. Let's just say that's the average. I won't do average. I never will do average. I only want to do great deals. So in a world where 4% is average, I'll probably want to only do deals at 8 or 9% cash on cash. So more than double. So I'm going to write up offers that are 8 or 9 or better.
Hmm.
And sometimes, like there was a time in 21 where I think I wrote up 100 offers and got nothing because the market was just too hot. And, that's just how I roll. I only want to do great deals. So I don't let the market dictate anything. I'm very much focused, daily discipline. I've been buying, when it's crazy, I've been buying at the bottom. You can't time the market. So all I concentrate on is making the next deal great. Sometimes that's easy, sometimes that's hard.
Great share. Okay. So I think I know the answer to this. Someone was saying, what's the best way to communicate with your clients? And I think we kind of distilled out there's no one right answer. It's what matters to them. But in
Mhm.
general, I think we're looking for efficient communication and then being open if they have questions. Would you agree with that?
I would agree with that. Yeah. Again, however the client choose to consume it, most of us, especially if you're dealing with people who have full-time jobs, it's about giving them the data on a consistent basis and then being around if they want to talk about it, whatever around means. Email communication, text, phone calls. Um,
Used to run a
I
marketing
prefer
agency.
phone calls. Yeah,
Yeah,
but
I used to run a marketing agency. It was the same way. It's like I don't need to come in your office every month. I need you to give me the
no.
data, and if I have questions, I want you to be able to answer it, you know?
Yep,
Because
exactly.
when we don't when there's no like the whole point, so we went to like the Hermosi event out by you in
Yeah.
Vegas. I remember one of the biggest takeaways was somebody was like getting inundated and they were like, "Oh, my clients want to know every data point and
Mm.
everything." And one of the guys on stage said, "When people start asking for just metrics and just data, I like to say, if this number wasn't where you would like it, what would you change?" And if they don't have an
Ah,
answer, he's like, you probably don't need to be tracking this number, right? So we should only be tracking data points that if it wasn't where we liked, we actually would make a change, you know?
yep.
Because
I like that.
otherwise, it's a sea of data. So
Amen.
okay, I'm getting all these questions, which is great. Um, have you tried any of your disrespectful offers on new construction?
It's funny. Just did this with Lennar in Vegas or Henderson. If you guys don't know, Lance Lambert put out a note that Lennar was courting investors. Hey, I'm an investor, so I reached
Literally in
out.
our community, everybody, Jen posted it, my business partner posted it for everybody
Yeah,
yesterday to get everybody to jump on it.
yeah, absolutely. So what I did is I reached out to them. I found a community that I liked. I started negotiations. I was going to buy all three houses that they had available, so I was doing a package deal. I was trying to create an amazing deal. We were on kind of round three of negotiations, and the rates fell, and I lost out on the opportunity. I lost out because I was 5 grand. I wanted 5 grand off a house, 5 grand more off them.
Profit.
And the guy I was negotiating with said, "Sorry, buddy, they're all sold." I'm like, so I should have bought them. But yeah, you just got to take what the market gives you. And right now, new construction's not selling, so go get it. I negotiated 19% off list price, and I was trying to get 21%, and I lost out because I got greedy.
Thank you for sharing those exact numbers, by the way. That was really generous because people hear disrespectful offers. They don't know what that means. And like you said, don't be crazy. I think some people think that means offering 50 cents on the dollar, which is never going
That
to
yeah,
happen.
that's stupid. Yeah,
But
that's not disrespectful. That's dumb.
yeah, it's delusional, right?
Yeah, delusional.
You just
Delusional. That's a better
actually
word.
made the original opening point, which is there comes a point where investors are excited and there comes a point where investors lose out. If the rates
Yep.
drop to a point and you just literally, it's got to be top of mind. You just experienced
Oh,
it.
I'm bitter. I'm upset.
Yeah.
Right. I almost had three brand new homes right in my buy box. My yield would have been 7.5, so it wasn't quite that eight. I was trying to get that last 5 grand to push it to eight, and I lost out.
Yeah. It's a good lesson on negotiation, you know?
Yeah, yeah. I got
Especially in
too
real
greedy.
estate.
My bad.
Everybody's got to win to a certain extent, you know? Everybody's
Yeah,
good.
yeah, yeah. Yep.
All right. Current stance. These are great questions, guys. So keep them coming. I want to make sure I get them all in. Um, so, oh yeah, somebody actually said, would you have ever bought new construction investment? Yeah, Jen's yelling yes because my business partner, that's all she buys. She's got a very
Nice.
good buy
Good for her.
box. You'll like her strategy. She buys new, holds it 7, 8 years, turns every one property into two. It's just automatic, like you talk about. She's living in.
Jen's a genius. She's a genius.
I know. I can't believe she works with me, but somehow uh, it pays to be handsome, you know?
Or
So,
delusional, but that's
yeah,
okay.
and delusional. Your current stance on DSCR loans and arm's length creative deals. Are you doing?
I hate arms. I hate arms. I think if you can't write a deal that makes sense with 30-year financing, the price isn't good enough. Full stop, black or white. I wouldn't touch an arm ever. I don't. I'm no. That's just who I am.
I agree
So
because
write them with 30 or
I was say reading what you do. One of the like, there's just 4 or 5 things you have to understand about real estate investing when you think long term. And one of the things is your deal's fixed and the market's going to grow. And when you introduce
correct.
an arm, you actually surrender one of the absolutely key fundamentals, right?
Yeah, one of the scariest days of my investing career is I owned an 18-unit apartment building, and the seller took back a second, 100K second for 5 years, and it came due in 2010, and I didn't have the money.
Yeah.
Now, luckily that situation worked out, but it didn't have to.
Yeah. Uh, Again, I just think you're fundamentally breaking something. Unless you know something nobody else does, I think you're
No,
fundamentally
not
breaking.
my thing. But as far as DSCR loan goes, I use them all the time. They're typically easy to do. You guys have no idea how lucky you are. There was a time where DSCR loans were a point and a half higher than conventional. They're essentially the same. And I have DSCR lenders that are better than conventional now.
Hmm.
Right. You do have to put 25% down, which is fine. You probably have a prepay of, 5 4 3 2 1 or something, or 3 2 1. But if you're a forever buyer, buy and hold guy like I am, doesn't matter. So I see no problem with DSCR lenders.
Yeah, it's great. And also, as you know, we've learned, I mean, you get to a certain portfolio size. You're either paying cash or it's one of your only tools left, right?
Yep. Amen.
Okay. Um, so actually, this one's from Jen. She wants to know if you can share your DSCR lender list with us. Do you have ones that you
Yeah.
recommend?
So, yeah, I'll talk about the guys that come on my channel weekly. So I have a year of 4 or 5 year relationship with. So if you are looking for like kind of an all is everything DSCR lender, it's Convoy Home Loans. I talk to the CEO and the president every week. If you mention one rental at a time, you actually get to them. You don't sit in a queue. So that should be seen as valuable, right? They got like 100 mortgage processors, but if you mention my name or my, company, Dustin and or Jonathan will take care of you. So that's always cool. If you are in a situation where you maybe have aggressive tax returns, maybe you have a bankruptcy, you have something like that. So you think you can't get a loan. I work with a public company called Velocity Mortgage. Their rates are in the eights. So it's not for everybody, but for somebody who has, a tax return that shows no income because you're just aggressive, you're a small business with not multiple years, getting a loan like that's better than hard money. Hard money is 12 or 13. So again, those are the two guys that I talk to every week. Stephen Dow at Velocity, and then Dustin and Jonathan at Convoy.
Yeah, thanks again for being so transparent. This is
Of
fantastic.
course.
Why we brought you on.
Yeah,
Um,
I got nothing to hide.
I want to recommend to everybody. I just dropped in some links again. Make sure you follow One Rental at a Time on YouTube. I've really enjoyed it. I just want to say thanks, Michael. You give so much data away, and you bring on guests that have all kinds of different data points, and you guys discuss it, you debate it. Sometimes it's just you. Like I said, I don't necessarily listen to every one, but I'm definitely listening to several a month, and I'm always,
Cool.
picking up new things. It's changing the way I think. And so for you guys in the community that are always hearing us share different ideas with you, you should know that one of the data sources that
Mhm.
we listen to is Michael, and you can get it, you can cut out the middleman and go right to him, which is great.
Yeah.
But I also want you to talk about your school. So I know, I started watching school, talk about the Hormozy connection, but
Mhm.
you seem to have built the biggest, real estate investing school. So who's that for? What's in there? You just give it a plug.
Man, the school community is something I'm so passionate about. It's actually something that I want to be known for. Like when you die, like what are you known for?
Yep.
I believe I'm creating the everyday wealth builder community inside school. Now, in order to do that, you have to keep the price point ridiculously low, which I have. It's $20 a month, which means 67 pennies a day. That's why we have nearly 500 people in it. It's an active community. We have now 9 different accountability calls, right? We have go givers who are running different accountability calls in the community. We have active forums where you can ask questions and get replies. I've personally put in thousands of dollars of free education in the classroom. So, you know, go get it, right? Spend 20 bucks, get $5,000 worth of education. Go nuts. And then again, it's the only place I go live where I let people ask me questions. So every Sunday at 8 a.m., if you want to get mentored by me or ask me questions, congratulations. Sign up for 20 bucks a month and you'll probably get me 3 hours a month. Because the only time I don't go live Sunday at 8 a.m. is when I'm traveling or speaking at an event. So that, let's call it three Sundays a month, which people really like. They like to ask me questions as the guy kind of creating this. So the school community is everything. And that's above a YouTube channel that's over 70,000. That's above an Amazon bestseller, one rental at a time. It really is the thing that I think I'll be known for, creating a community of everyday wealth builders.
Absolutely. By the way, just so you know, when I tell people about you, I feel like I was like, he's the modern day author of the Rich Dad Poor Dad book. That's what I say because I feel like it's
I
just more
appreciate that.
it's just 20 years later and it's more today. And so for anybody who's checking out, give it a listen, give it a read. We're gonna share more of this in the community. So I love what you do with school, and I'm super anti-spam, but you literally have access to what we think are 100 plus of the most serious property managers all over the country. If there's anything we can do where you set up a sub channel or something for property management connection or info, love to help you out in any way you want, and I know my clients would love to
Yeah.
give value. Like they do this on Bigger Pockets. They're all over Bigger Pockets. But if there's anything our community can do for you, let us know and we
Yeah.
can.
I mean, this is just, you just asked, so it's totally off the top of my head. I would, if I was a go-giver out there and saw value in being around 500 of the other investors, I would probably sign up and then, this is what I see work the best in school. Sign up, interact on the forums, get known by people, and then in 2 months, create a accountability group run by property managers, right? Because again, one of the things you got to remember is these 500 folks are not property managers; they are investors, and a lot of them gripe about property managers. So again, if you want to get around the largest active community of investors, sign up, be a good person, right? Give value, and then in 2 months become the known entity
Yeah,
in property management. Just run it, right? Because again, these 9 accountability groups, I'm not a part of any of them. I don't show up, right? I guard the community like a hawk. I protect it, make sure they're only go-givers. And if you're a dick, I'd kick you out. I don't need the money, right? I'm trying to protect the community. So that's what I would do. And yeah, go sign up. It's 67 pennies a day. I think you can afford it.
agreed. And yeah, I want to stress to everybody, we want to go add value. This is what we talk about, how we talk about Bigger
Yep.
Pockets, how we talk about even our community. You got to become the subject matter expertise and your subject matter expert in your market, add
Yep.
value, build relationships. But everybody's always saying, how do I meet these theoretical investors that are investing in my market? And when you meet
Get
some,
in their world.
yeah, like he's got
Yeah.
500.
And oh, by the way, school has a map. You can actually see which people are around you.
Oh my gosh. All right. Well, I'm going to join just for that. Show
There
that
you
to the
go.
whole
Have fun.
community. I was already going to probably join after this call, but I love that. Well,
Yeah, there's a
Michael,
map. There's literally a map that shows you where everybody's at.
it's amazing. But all US or mostly US?
I would say mostly. I would guess 95%. Well, US and Canada,
Yeah,
95%. I do have people in Latin America, Europe, Asia,
it's great.
but yeah, 95% North America.
Well, Michael, I am so glad that we got to do this. Like I said, I've been learning from you and sharing some of the stuff. So it's so good to see the community interact. And I hope we can do this every once in a while when big
Yeah,
things
send me
happen.
a note. You know how to get a hold of me.
I appreciate it. Thank you so much, man.
All right, take care. Later.
All right.
Bye, everybody.
All right, that was great. So I don't have a way to cut everybody else out, but okay, he left anyway. So thanks for watching, guys. I'm going to upload this recording to the community, and we're going to help you guys create some content based on this concept. So I hope it was helpful for you guys. Let us know what you thought. Log into Scale Club where we post the video, ask your questions. We'll connect you with Michael, and appreciate you being here and hope to do some more of this stuff with you guys soon. Take care.